Hey, this is Sasha. Thanks for joining me in this week's episode. And what I want to do is share with you today, should you go ahead and pay off your debt, or should you take your money and invest it into stocks, bonds, mutual funds, or something else? So we're going to go ahead and answer this question for you today, so that way you can be smarter about your money, finances, and continue to build wealth. All right, so a lot of people are always questioning and curious, hey, I've got these debts that I am paying money on, whether it's a car loan, a mortgage, it could be credit card debt, and they wonder, hey, the market's doing well, or maybe the market sold off in a big way, and now it's a good time to buy. So in either case, they're wondering, should I go ahead and take my money and either invest it or go ahead and still continue to try and pay off debt? So first thing, before we continue going, I do want to remind you we do have some freebies on our website at MyLittleNestEgg.com. So don't forget to check those out. But with that being said, what people don't really realize is the approximate interest rates for different debts and investments can be really high. And the first thing you have to look at is, what's the big debt that you have? Are you the type of person that has credit card debt? Because if you've got credit card debt, you're basically looking at paying about 19% interest on that credit card. Now, some credit cards, of course, you're going to be paying 29% and much more, even 34% on some of them. So it's very, very expensive to have credit card debt, and they really just keep you in there. You got to almost crawl yourself out of it like quicksand. So this is a very difficult debt to get out of. So make sure you pay that one off first. Now, student loan debt is another one that people have. Usually your interest rate's around 5.7%. Car loan, you might get around a 4.9%, mortgage 4.5%. And this, of course, all depends on interest rates and many other factors and variables, your credit rating and so forth. But once you get into actual things that accumulate you money, think of like a high yield savings account, you might only get 2%, 2.2, 1.5. You're not going to get that much. And a diversified dividend portfolio on a year-to-year basis on average might give you 5 to 6%. Some years you might get 8 to 12. Other years you might get, 4 to 6 or a down 12. So on average, looking at about 5%. So again, unless you are an active trader or investor, which by the way, you could take a look at some of the other things that we do on our active trading and investing site at tradersfly.com or that YouTube channel. And there's a lot of great resources there if you're really interested in active trading. But if you're not, and you're looking at your debts, really the big thing to look at is, hey, where do you have the biggest debt? And if you've got a big debt at 18%, like a credit card debt and a student loan debt, it's probably wiser to go ahead and pay those things off first. So that way you go ahead and take care of any outstanding things that are going to continue to sink. Because if you've got a lot of money that you're paying off debt, it's just huge. It just continues to snowball. And even if you're making 6 or 10% on your investments, or even 15%, it still doesn't justify the huge debt problem that you're really going to have to struggle to get out of. So a lot of times, many people don't invest their money when they have credit card debt. And that's simply because credit card debt is kind of the worst debt to have. It's one of the toughest to get out of. Whereas maybe something like a student loan debt, you're usually at a lower rate, or even a car loan or a mortgage. People in that case say, hey, well, this is maybe a mortgage is a better debt. It's good debt because you could be building property value. Your property could appreciate. So it's not too bad to have. There's a huge asset tied to it. But when it comes to things like a credit card debt, you definitely want to pay those things off, because you could see how big of an outlier that is and the problems you would experience when it comes to that. So some other things that you may want to check out, and consider is what many people don't think about when they're getting into it is, what interest rate are you paying? That's really the first big question, is what interest rate are you paying on the debt that you have? And if you have kind of a low interest rate, in that case, hey, maybe it could be an opportunity to look at some investments. If you have a high interest rate, it's probably not the best opportunity to go ahead and start investing right away. The other thing is, look at your taxes after investments. You're going to have to pay a lot of taxes on your investments, especially if you're very active on your trading or investing, or you're taking some profits. You'll have to pay taxes. So even if you're making 6, 7, 8%, that 6, 7, 8% might actually only be 4, 5% by the time the taxes roll in. So be very careful about that. And that's why sometimes just paying off the debt is a lot better, because you don't have to deal with the tax part of it or the tax consequences. So you're just going ahead and paying off the debt, and then it's gone. And then the final thing is, of course, your risk tolerance. Your risk tolerance is really the psychology part of things. What most people don't really think about is, hey, what's my risk tolerance when it comes to investing? Do I want to be a safe investor, or what's my risk tolerance? And really the personal mindset behind having this debt outstanding. If you've got debt and you've got a credit card debt of, let's say, $30,000, and now you're investing, but your investments aren't doing so well now during the next month or two, well, how are you going to feel about that? How are your emotions and how are you personally going to feel about these kinds of things? If you're okay and your risk tolerance is pretty high and you're okay dealing with these kinds of things emotionally, then it might not be a bad thing. But on the other hand, if your risk tolerance is kind of, hey, I really want to play things safe, then definitely pay off as much debt as possible, or all your debts, maybe beyond your mortgage. And that's when you could go ahead and do some investing. Because if you've got a car loan, student loan, credit card debt, you probably don't want to get to investing. And that's my final tidbit and point for you. If you've got debt that's very, very high interest rate, things like credit card, maybe anything above 4%, 4% beyond your mortgage, then you probably want to get rid of that debt first before you do some investing. And that'll give you a clear head, clear mind. And that way, once you start looking to invest, you'll probably go ahead and at least kind of crawl out of things. Because remember, it's much harder to earn money and it's a lot easier to spend it. And that's why the credit card debt or many of the debts are much higher than actually the savings accounts or the investment things, because it's way harder to earn money than it is to spend it. So thank you so much for joining me for this video. Hope it gave you some thoughts and things to think about. Remember to hit subscribe here on the YouTube channel if you're brand new to this channel, or join us on our newsletter list so that way you can get some other great insight on personal finance, wealth building, and basic investing. Thanks again, and I will see you next time.